All right, everyone. I show that it is 1 o'clock Eastern on the dot. So we are excited to get started with a great session that we have prepared for everybody today. Today we've got a great panel assembled on a very, very topical issue in the wake of Silicon Valley Bank's failure. We're talking about cash management and diversification strategies that CFOs may want to consider in response. So we've assembled an awesome panel, lots of different viewpoints represented here. So we're really excited that you took time out of your day to join us here. Before we get started, I do have just a few housekeeping items to cover. So I'll give everyone just a second to get settled and we'll get started momentarily with that housekeeping. But in the meantime, if you want to tell us who you are and where you're calling in from in the chat, we love to kind of get the conversation going there. So I will let everybody know that I'm Allie from Houston, Texas. Oh, we've got Dallas in here. Oh, I'm gonna just host a panel. All right. So with that, we're at 101. So I'm going to actually go ahead and get us started here with just a little bit of housekeeping before we start. So first of all, I already got the question. Is there going to be a recording? Absolutely. We're recording right now, and we will make that archive available to you on demand starting tomorrow. So hang tight for that. If there's any part of this that you want to share with a friend or colleague, or if you want to go back and revisit it, you're welcome to do that. We'll have that in your inbox tomorrow. Secondly, polls are required for those of you who are joining us from CPA Academy. In order to get that CPE credit, if you're here for that, be sure to respond to all the polls. So I actually have the first one ready to go right now, and you can be responding as I go through this housekeeping. And that is, what accounting system do you use in your business? QuickBooks Desktop, QuickBooks Online, NetSuite, Intact, or something else? And if it's something else, let us know in the chat. We're curious. So yeah, and then lastly, we are on chat as well as Q&A. So I'm in the chat. I have my buddy Sue here from Santeam in the chat, and we're there to moderate if you have any questions or need any help. And then there's also the Q&A function if you want our panel to take a look at your questions and potentially respond to them at the end of the presentation. We will definitely try to get to as many of those as we possibly can. My name, I forgot to introduce myself. I'm Allie Collins. I am the new head of marketing at Santeam. Santeam is a cash management platform for accounts payable, accounts receivable automation, and cash flow forecasting. You'll get to hear a little bit more about that from the rest of our panel here in a second, but I'm mainly just here to kind of moderate the panel and be here for you if you need anything. So with that, I'm actually going to go ahead and do a brief introduction to the panel. We'll get deeper into who everybody is in just a moment, but I'll just quickly let you know who's here joining us today. So I have BC Krishna, who is the founder and CEO here at Santeam, joining us. And then we have two very special guests joining us. Chris Sands is the CFO at IntelliCare, and he'll tell you more about what IntelliCare is in just a moment. And then we have David Koda, who's the Executive Vice President, I believe, of the business division at First National Bank of Omaha. And he is here representing the bank's point of view through all of this. So we're excited to have him as well. So I think with that, I'll just jump into a quick overview of what we're going to be covering today. So the first topic is just going to be some key takeaways from SVB for CFOs. So what might you need to be thinking about as a result of all of that? And then, is there risk of bank failure that you need to be thinking about? What should you do about it? What are other companies that look like yours? What might they be out there doing? We'll talk a little bit about the pros and cons of some of those tactics, and then potentially some solutions for how to resolve those. And then, like I said, audience Q&A. I already see so many questions coming in. I already have 30 of them. So you guys are really on it and ready to talk. So I'm really excited about that. So I won't waste any more of your time. I will actually take us just straight into the panel discussion. I'm going to stop sharing my screen so that you can see our panel. And give me just a second to pull up my first question. Oh, let me actually end the poll that we've been running here. So it looks like if you're able to see, We have a good mix of lots of different things. A lot of you are on other ERPs, so that's very interesting. So I'm excited to see what those answers are in the chat here in just a second. Okay, but with that, I'm going to actually start by asking the panel to just sort of give us an overview of who you are, what the perspective is that you're representing today, and just what your reaction is to the news cycles around bank failures and what the big takeaways are for this audience. So let's actually start with Chris. You're a CFO, just like a lot of our audience members today. Can you tell us a little bit more about your role, your background, and how you've been impacted by SVB at all?
Sure. Chris, before you go, and Ali, I see that some people are saying that the chat is disabled. Is that something that...
Chat is disabled?
So just something to take a look at while Chris is doing his thing.
Bummer. Okay, let me take a look at that, and yeah, keep going and I'll take a look at it.
Yep.
Okay. Well, I certainly can't help with that, but happy to give a little background on myself. Thanks, Ali and BC for having me. So as Ali mentioned, I think on the intro slide, I am the CFO of a business called IntelliCare, which is a labor platform for healthcare. So you can think of it as marketplaces that support gig work for nurses. So primarily nurses looking to seek per diem work come to our platform where facilities, healthcare facilities and providers post their per diem needs and we match them up. I've been here for a little over a year and a quarter. Previously was at AP automation company Mineral Tree as CFO, and then earlier in my career ran various finance functions under the office of the CFO, including treasury, including investor relations, FP&A and the like. So thrilled to be here and happy to contribute to the conversation.
Awesome. Yeah, thank you for that. So up next we have David. So we're really excited to have somebody here representing, the bank's perspective. What can you tell us about FMBO? And I imagine there's been a lot going on in your world for the last few weeks. So what does that look like?
Yeah, thanks, Ali. As Ali mentioned, my name is David Cota, Executive Vice President at First National Bank of Omaha, known in the market as FNBO. I've been with our company for 24 years. Prior to that, I spent 4 years at JP Morgan Chase in Dallas. Just a little bit about FNBO. We're a $30 billion bank headquartered here in Omaha, Nebraska. We're privately owned. We're a family-owned bank. Last December, we actually celebrated our 165th anniversary. And our current chairman and CEO is Clark Lauritsen, and he represents the 6th generation in his family to lead our company. I mentioned that because it's important to note that our bank obviously is, with a history going back 165 years. We've been through a lot of economic cycles. And I think we have a unique perspective as one of the largest privately owned banks in the company. So the point of view that I'll bring to this conversation is that of a regional banker, again, operating primarily in the middle third of the country. We do have a national view to our business, though, as well. We have a national credit card business. We manage and issue card programs for national brands such as Ford and MGM, Amtrak, Shields, a handful of others. But I thought if I could, Ali, I would begin just to your question of, what's been right in front of me and how have the events of the past couple of weeks with the failures of both Silicon Valley Bank and Signature Bank impacted us. I thought I'd maybe just offer a quick perspective on that if that works.
Yeah, definitely.
Okay, let's perfect. So, we've been having a lot of conversations, as I'm sure all of you could imagine, over the past couple of weeks, just trying to put context around what has happened. I think that the context can actually set up this conversation pretty well on diversification and effectively managing cash balances within your company. So here are a few thoughts, maybe just to start from my perspective. First, the banking industry as a whole is very strong. You can have confidence in banks, but bank failures do happen. It's unfortunate when it does happen. However, like all industries and all business types, banks are not immune to failure. What's unique is that banks obviously have a responsibility to hold customer deposits. So the implication of a company, a bank as a company failing is much greater maybe in some regards than certain other businesses. That's why FDIC insurance was created in 1933 to protect depositors against that risk. But it's also why business owners, CFOs, finance professionals need to be thoughtful on how you manage your cash balances and you manage this risk. I really think that this most recent event has been newsworthy for a couple of reasons, and I'll offer just three as we start. First, over the past 5 years, there actually have been very few bank failures. From 2018 to 2022, there were only 8 banks that failed in the US, and they represented about $670 million in bank assets. And so that's less than $100 million per bank. So fairly small banks. And it was actually 867 days from the last bank failure in October of 2020 until Silicon Valley Bank failed in March of this year. That was the second longest period of time between bank failures in our country since 1933. And you don't have to look back very far to find a period of time that was much different. 10 years ago, 2008 through 2012, coming out of the Great Recession, there were actually 465 banks that failed. And they represented over 700 billion in bank assets. So a much bigger dynamic, a much higher volume of banks failing at that point in time. And if you go back even to the early 1930s, coming out of the Great Depression, over 9,000 banks failed in that moment in our country's history. That's more failures than there actually are even banks in the US today. There are about 5,000 banks in the US. So, while the banking industry on the whole is strong, it's important to recognize that failures have been a part of history, and it's something that we need to be mindful of. The other two aspects that I just think were unique to this current moment was, first, the size of these failures. Silicon Valley Bank at 200 billion in total assets when it failed, that was the second largest bank failure in our country's history, next only to Washington Mutual, which failed at 300 billion in 2008. And then Signature Bank, which followed sadly a couple of days later, was number 3 in our country's history. So not only had we been through a period of time where there had been a small number of failures, but then we had 2 of the largest failures that happened almost successively in back-to-back days. And then finally, it happened very, very quickly. As a point of perspective, when Washington Mutual failed back in 2008, they experienced a bank run similar to what happened here most recently. But in that case, Washington Mutual at $300 billion, they saw about $16 billion of their deposits leave over a 9-day period of time. That represented 9% of Washington Mutual's total deposits. When Silicon Valley Bank failed, they experienced a bank run where they lost $42 billion, 25% of their deposits on a single day. And when they opened the next morning, it's reported that they had requests for an additional 100 billion of withdrawals. That would have equated to, in 2 days, them losing 81% of their deposits. I mean, that's pretty stunning. So when you consider the impact of electronic banking and, ever-present social media commentary, it just really is important that this issue from a risk management standpoint is back on the table. And so that's what we've been doing a lot, Ali. We've been, having a lot of conversation with customers on what happened, why it happened, how our balance sheet here at FNBO is strong and different in many ways from the situation that occurred. But that context around bank failures is important, especially for this audience, as you think about maintaining balances that may exceed FDIC insurance in banks.
That's super helpful, David. Yeah, great context to get the conversation started. So I'm now going to flip over to BC with Santeam. Can you tell us a little bit more about Santeam and why all of this has been on your radar recently?
Yeah, so thanks, everybody. My name is BC. I'm the founder and CEO of Santeam. And what we do here and have been doing for the last 3.5 years or so is building a more sort of comprehensive cash management platform for small and mid-sized businesses. And the premise is a simple one. Cash is, as they say, the lifeblood of the enterprise. And understanding the different elements of how your cash behaves from the standpoint of accounts payable and extending DPOs and accounts receivable and shortening DSOs, looking at your forecasts in the short term and understanding how that cash is sort of coming in and out, and what you need to do to manage your cash so that you can achieve your near-term operating objectives is really the crux of what Centeam provides. When Silicon Valley Bank failed, it felt to us that, having the ability to, as Dave said, mitigate the risk associated with this kind of bank failure, rare as it is, unlikely as it is, it's just good common sense. And the idea of being able to, really mitigate risk associated with the deposits, was something that businesses clearly needed to do. The question is, how do you do it well? How do you do it at scale? How do you do it so that it doesn't require a lot of, manual work? And that's how we got into this kind of world and felt that, diversification is clearly an element of managing cash. And so that's kind of how we come at it, Ali, looking at a cash management platform necessarily having to provide the ability for small and mid-sized businesses to basically diversify their deposits and manage cash more effectively.
Love it. Can't wait to get a little deeper into that momentarily. Lots of you asking about the polls, so let's go to the next one. So this one, let me go back here. Relevant to what we were just talking about, how concerned are you attendees about the risk of bank failure? I'm guessing that the answer is somewhat if you've decided to join us today, but very curious to see where the bulk of you sit. It does, so far what I'm seeing is that about a third agree that they're more concerned since the SVB failure, which is not super surprising. So I'm going to give y'all just a few more seconds to respond to this one, and then I will share the results, and we can see if this is similar to what the panel was expecting to see or a little bit different. But yeah, I'll just give y'all a few more seconds here. All right, closing it down in 3, 2, 1. All right. Are y'all able to see the results, BC and team? Okay, so about 8% say they've always been concerned, 37% more concerned since SVB. Somewhat concerned is where the bulk of you sit, but it looks like 89% have some level of concern that probably brought them to the conversation today. So David, is that consistent with what you're seeing with your banking clients? Like, what's your take? Is this what you expected?
Yeah, like I said, I think we have come out of a period of time where this topic just as a risk that needs to be considered in the overall framework of how I manage cash, and as a company, where do my deposits sit, and who do I bank with, and what tools do I use? I think this has prompted the topic to come back onto people's radar screen. So it is very similar to the response that we're seeing, conversations that we're having. One of the things that I've noticed, and as I talk with peers, in other banks across the country, I think there's, and I was looking at the kind of the location of a lot of the participants. I think there's also a regional effect to this. I mean, it's natural, right? I mean, if you're operating in and around where a bank failure has occurred, it naturally is going to hit home a bit more. And so, your feelings are going to be more acute. You're probably going to be a bit more tied into it. Because of the size of these two bank failures, and again, the speed at which they happened, again, I think it's important that this conversation has been back on the table. The banking industry is strong, it's well capitalized, and yet, as BC mentioned, even as remote as bank failures are, it is something that you should be thinking about and talking about as a finance team, and as a leadership team within your company. So yeah, I would say that it is similar, Ali, to the general sentiment that we're running into in conversations we're having every day.
Dave, if I can just jump in here, one of the things that is worth just really maybe discussing or talking about is, if you were to take the 2008, WAMU crisis, WAMU failure, and the Silicon Valley Bank failure, from an asset size standpoint, they're sort of roughly the same order of magnitude, both large banks, both big banks, both prominent failures.
Right.
But there's sort of something qualitatively different, right, about them. And particularly because, the WAMU failure was all around the mortgage crisis.
Correct.
And arguably much of the, concern was more around consumer deposits, which were largely under the FDIC limit.
Right.
Whereas what's sort of really unique about the SVB and perhaps the interest that we have today is that it was primarily all businesses. And in something like 80% of the deposits were over the FDIC limit. And so, I mean, I think the interest, in diversification, for lack of a better term, is really different now, right? And particularly because of this and the sort of shining the spotlight on the FDIC insurance and so forth. Just wanted to, get your perspective on that, and certainly Chris weigh in as well, because you were impacted by this too, right?
I certainly was, and David, I'm happy to go first. So, in hindsight, my introduction was very weak compared to these two guys. So I have a lot of catching up to do the rest of the webinar here. But so maybe
great.
Okay, I'll start with kind of my experience with SVB. So, we were an SVB customer. I'm actually now a third-time SVB customer at different stops along my career. We had our operating account and the vast majority of our investments at SVB. So we were what I would characterize as very impacted and scrambling for the reason BC mentioned is 250,000 doesn't really move the needle for our business. And we had, approaching $10 million of expenses that we needed to pay the week after the bankruptcy. And so it has certainly changed the way I think about treasury. I think we're going to get more into this, and we can kind of talk about, for kind of my peers on the call, like your priorities kind of pre the SVB crisis. Treasury, I'm guessing for most, was pretty near the bottom of the list, because like if you're like our business, it's, we don't have complex business operations that necessitate a super sophisticated treasury strategy. We weren't doing anything exotic with our cash. And so we assumed it's at a large bank, a bank that's very reputable in the ecosystem in which we operate, that I've worked with on multiple occasions, including at a public company where I ran treasury. And so again, when I look at my things to do every week, treasury was never really at the top until it was, right? And so have certainly spent, to your question to Dave earlier, more of my time over the last several weeks. And I'm in fact prepping for our board meeting next week. And this is a topic not only for the audit committee, but also for the overall board on what changes we're making and what we're doing to ensure something like this doesn't happen again. So, to BC's point, the commercial nature of the deposit base at SVB has caused lots of attention, not just from the businesses, but think about all the investors behind those businesses and the like. So it's been definitely a significant change in how we would talk about, or the attention we would give to treasury relative to, even a few months ago.
It's interesting, Chris. One of the things that you said, which is absolutely true, is you said that SVB was a very reputable bank in the ecosystem within which you operate, and the concentration for that bank in that industry and with that customer base, had for many years been one of their kind of shining, value propositions, and it was really strong. And at the same time, BC, to your point, when you are talking with your bank, whatever bank it is valuable, especially if you are a large depositor, to ask some, very direct questions around the diversification of the business model, your exposure to a variety of industries as opposed to one. Because, what we saw in 2 days for 81% of their deposits to move, what it means is that it basically moved en masse and as one. And that's what an industry concentration, that's the other side, or that's the downside of an industry concentration that would have been really hard to predict. I mean, let's all be honest. It's easier to, in a retrospect, look back at this. And yet at the same time, when it emerged, I think it became, obvious that the type of questions, Chris, you'll likely get from your board is around diversification. And, is there, where we are depositing cash, is there an exposure or a concentration to a specific industry that could precipitate a similar series of events, at some future point, prompted by, another action that we may or may not be able to predict. So those are very present questions that are getting asked a lot. And I think they should. I think it's helpful for businesses and depositors to know their bank as much as, we really try to know those businesses themselves.
I can,
let's take a step back, because I think most of this audience probably is really familiar with what we mean by diversification. But BC, can you break down for us, and just in case anybody's not up to speed, what do we mean when we're talking about diversification, and why is it relevant to this conversation?
Yep. So, just 101, right? I mean, the general idea here is to recognize that bank deposits are insured by the FDIC, as Dave said, to the extent of $250,000. And that, just to keep it simple, it doesn't really matter whether it's a consumer account or a business account or a government account or any kind of account or a trust account. $250,000 is pretty much the cap. Obviously, that's an account at a bank. So if you have a deposit and you basically move it or distribute it, break it up and put it into 3 or 4 or 5 different banks, then you get a $250,000 cap at each bank, right? And so ideally what you would want to do is to find a network of many banks and take your deposits and carve them up so that no individual deposit is more than $250,000, and thereby ensure that your entire deposit base is completely insured. But that's hard to do with the larger deposits you have. But that's the general idea. The principle is really simple, right? Which is that you take your deposit and you diversify across a number of different institutions so that you're not potentially impacted by the risk that any one bank might take and cause problems for them. Just to build on what Dave said, right? Risk taking is just the nature of building a business. As we run businesses, we all take risks. And when you take risks, you have to deal with those risks. Sometimes those risks are managed in a way that, balances growth and take advantage of opportunities. But sometimes, you take risks that are outside of your control, and that's just sometimes what impacts you. And so Silicon Valley Bank is sort of unique in the sense that, as Dave said, they were very concentrated in a certain sector, which ordinarily you might think of as a great advantage, but in this particular case, unfortunately, it didn't work out for them for reasons other than the sector that they were operating in.
Right.
Yeah. I'll jump in just because I was smirking as BC was explaining diversification, and he can probably guess why, because he's laughing, which is this notion of spreading up commercial accounts into $250,000 chunks is easy for someone to say who's not tasked with actually responsible for setting up all of those accounts, managing them, reconciling them every month when you do your balance sheet. And so, I think that's obviously the other part of the conversation that we're going to get into, because I know Santim has solutions that help with that. But when we get there, happy to kind of share the perspectives on what's the right balance, right? So, there are diminishing returns to trying to completely eliminate risk. And so, I spent in wake of SVB and revamping our treasury strategy, I started with what's the right mix, right? Not what's the least amount of risk I can take on, what makes sense for our business. So I'm sure we'll get there.
Yeah, I mean, how did you?
Get there? And I think you're exactly correct, right? There are a number of different strategies that people can take. I mean, if you have some magic way to diversify your deposits to that 250 limit, that's great. If you don't do that, then you have to decide what risk you're willing to take. And, but any which way you look at it, there's some degree of pain associated with diversification, which we will get into.
Yeah.
I mean, Chris, do you want to jump into, what your strategy is and how you arrived at it and how you're balancing those two trade-offs of convenience?
Yeah, happy to. So I mentioned we had been longtime SVB customers, both as an institution and telecare, and me personally at other businesses as well. We have largely moved, or in the process of moving, to working with mega money center banks, 2 of them, for diversification. And that's kind of where I landed on the kind of risk reward trade-off of the operational complexity and, getting the benefits of diversification, which are obviously counterparty risk is one, liquidity is the other. But it also goes beyond diversifying away from banks. So I think kind of the third piece in this is like, what do you do with your excess cash? And like, for instance, at SVB, we had it in a what I consider to be relatively safe vehicle that generated a good amount of yield. I knew it was kind of split between a money market fund, which was off SVB balance sheet, but also an SVB product that had balance sheet exposure. And so, that stung a little bit as well. And so thinking about what we do with our excess. So when I think about diversification now, it's kind of having operating capabilities, kind of core operating capabilities at two mega money center banks where, if there are banks that are too big to fail, they would fall into that category. And then with excess, actually getting them off of the bank's balance sheet and into something that is exclusively U.S. government security, short-term U.S. government securities are very high quality corporate bonds. And none of that still without risk. And like, this may be a very unsatisfying answer, but like, if those banks and the U.S. government, like, and there's certainly contagion, right? So like the benefit of the diversification is also operational, right? Because if one of these is going to have a run, the other one is going to as well, because I think people generally kind of view them in the same light. But like, from my perspective, it's like, well, what else can I possibly do, right? Like, if my money is not safe at JP Morgan, Bank of America, Wells Fargo, and the U.S. Treasury, like, I'm not sure what else to do. And so that's kind of how I got comfortable with this is something that can be managed by, we have zero Treasury staff. I mean, we have a 35-person finance team, but no one dedicated to Treasury for the reason I made earlier, which is it's just not that complex, or previously was not that complex. And so, how can I have the folks that kind of tend to our accounts, manage the new structure while also mitigating the risk relative to where we were previously. So that's where we've landed. I'm guessing I'm going to get, Dave's already smiling. I know BC is going to come at me, so I'll take them all on now.
Let me come at you.
One of the reasons why I was smiling is, you mentioned something that is different though today than for the last 10 years, when you talk about moving some of those excess deposits then into, government-backed securities, short-term Treasury bills, maybe a money market fund that invests exclusively in that. The interest rate environment is very different. I mean, there was a 10-year period of time where the opportunity cost of holding cash in an operating account or in a bank account was effectively zero. I mean, if you were getting paid zero, whether you were in a market-based instrument or in a bank account, back to Treasury management was pretty straightforward. Well, the game's changed. I mean, I've been talking to a lot of people on our team, and I said, the minute that there was a number to the left of the decimal point in terms of short-term cash rates, it mattered again. And so, Chris, someone in your chair, you have to think about, if you're carrying balances, what's the opportunity cost of that, and could you put it to work? And so it is becoming a bit more complex. I saw a question pop up in the chat or in the Q&A where, Chris, based on your strategy, the question was, does that spell trouble for regional banks like ourselves? It's something we're talking about. We're, maybe somewhat unique in the sense that we do have a long history in many of our large commercial depositors. We've got relationships that go back many years with them. And fortunately, we do have solutions as well, right, to extend FDIC insurance across a large balance while that deposit does not need to leave. I saw, and it'll be a part of the conversation as well, BC, that we get into here a bit, but options like insured cash sweep that extend FDIC insurance more broadly not only can be used by regional banks like ourselves to help a large depositor that may have $10 million be insured, but they also can be creatively used by, progressive, innovative companies in the industry that as well are trying to find solutions to balance this problem of the operational efficiency of spreading your accounts over 10 banks with the desire to manage and mitigate that risk. So, we're hitting on, I think the kind of daily conundrum that we're all facing today as we look at this problem and how do we solve it.
Yeah, it's fascinating because the conversation, and I'm scanning all of the questions that are coming along. I mean, they're really great questions, and they're the kinds of questions that I would be asking, right? If I was faced with the situations, how do I get my limits under 250K? How do I spread out across multiple accounts? What does it mean for liquidity? What can I do to gain better yield on these accounts, right? These are the questions that suddenly, which were, just to be clear, a month ago, nobody was thinking about this stuff, right? And everybody suddenly is faced with having to deal with, at some level, a treasury function within even their small company.
That's right.
And the reason I was smirking and wanting to buttonhole Chris on his whole thing was, hey, you've got a job to do, you've got a company to run, I get it. Right? And by the way, guys, Chris and I used to work together, so I feel like I can give him a hard time. And so the point is that, your strategy of, and I'll say this, Chris, and I know you won't take offense if I say this, but your knee-jerk response is to say, I'm going to go to a big bank and I'm going to rest assured that the big bank is not going to fail. Although 10 years ago, we were faced with that similar contagion. And by the way, if it turns out that the entire 26 million universe of small businesses decide to go to the big banks and concentrate their deposits in the big banks, guess what we've done? We've created systemic risk in the industry by removing the very thing that we were trying to do, which is diversify accounts across banks, right? This is not a great thing. And so, at some level, I think we just need to do some navel gazing as an industry, as a community, and sort of ask the question, is this really the right thing to do? What are the other approaches that we need to take?
Yeah. And I think the good thing is there are solutions emerging, and, these conversations are highlighting what solutions are available. I feel a responsibility for us to talk about the solutions that are available to help balance this problem, to talk about regional banks and the strength of the banking industry, because you're right, BC, there are implications that could roll out of this. The important thing to me, and the thing that I've been impressed by, is the fact that we are now having a conversation, and these are good discussions. And like any moment of disruption, it's going to prompt and trigger innovation. And I think there will be even better solutions that, will begin to emerge. So insured cash sweeps away today, CEDARS, I saw that pop up in the chat. That's another solution. So you can work with your existing bank, and you should have these conversations with your bank. First, talk about the risk you're willing to take. Chris had, good conversations, it sounds like, within his company around how do we balance this risk. You can't flush all risk out of your cash management or your treasury management program, but what's right for us, and then, begin to evaluate your options so that you don't just become wholly inefficient because all of a sudden you have this patchwork of multiple accounts spread, all over the place.
I know that at some point we're going to get to the, I'm going to, Ali, what are you going to say? I was going to say, I was
going to drop the poll and let people start responding to that, but you keep going while I launch the poll and people can respond while you're talking.
I think that this is probably, it's on my mind, and Dave, a question for you, and perhaps on the minds of the many people that, have joined us today. What about this idea of raising the FDIC limit? Is that something that is even viable? And, does it even move the needle? Because the way I think about it is that the FDIC limit is really built with the consumer account in mind, and I don't think it's likely that the limit is going to be raised to 10 million or be taken away. And then just another sort of follow-up question, and mostly to educate myself and perhaps the audience as well. How is the FDIC funded? Is that through, it's an insurance policy that you take out, the banks pay into the FDIC fund?
Yeah, I'll start with that. So there is an FDIC assessment, if you will, that we and all banks pay into an FDIC insurance fund. It's based on the level of deposits that we maintain broadly within the industry. And so we and all banks pay into this fund. And that really is the industry creating an insurance protection for depositors, because, while banks have healthy competition, certainly amongst each other, no bank failure is a good thing. And so we want depositors to feel confident that they can, be settled even in the event of a bank failure. And so, again, FDIC was created in 1933, coming out of the Great Depression. As I mentioned, there were 9,000 banks that had failed. I think between 1929, the crash, and 1931, so in a really concentrated period of time. And when FDIC insurance didn't exist, if you were a depositor at one of those 9,000 banks, it was a tough place to be, because it was likely you were going to experience some loss. So yes, as an industry, we support the program through an assessment. And in the same way that I think there will be technological innovation, I also, the two questions that you asked are absolutely discussions that are happening in the industry. I think there will be regulatory innovation, right? Do we look at the FDIC insurance limit? Can it go up? If it does, what would the effect of going from 250 to 500 be? Would it provide more protection? Would it be worth the cost? I also think there's discussion around, if you take the 3 or 4 largest banks, that, there is conversation. Are they systemically too big to fail? Okay, well, if you move those to the side, could the industry create an FDIC insurance fund that would cover, the rest of the deposits? So there, I mention those simply as ideas are percolating. I don't know where the solutions will land. But again, it's good conversation to have, because we want to make certain at the end of the day that our banking industry and the banking system in the US remains diverse, well capitalized, strong. And, we all want to protect against an unintended consequence that, all of a sudden there's just this huge concentration and a limited number of companies or banks, that at the end of the day isn't a good outcome. And I don't believe it will be the outcome, but we clearly need to respond as an industry.
Ali, before you go to the poll results, let me ask something a little more provocative that's almost the opposite of BC's question. Do we need FDIC insurance? Period. Is it actually do? And then you're in Omaha, so I'm sure you saw what your Oracle said this morning, which was the government will always step in and make sure depositors are safe, and can regulate banks in other ways to make sure that there are enough assets to cover the liability. So is FDIC insurance just a very nice explicit blanket for consumer depositors, but there's this kind of implicit guarantee that for the integrity of the overall banking system, the government would never let depositors lose money, because that would be the ultimate death knell to US banking?
Yeah, it's a really good, and it is a provocative debate right now. We had that debate as an executive team. Is there this moral hazard or this explicit guarantee of all deposits in the system coming out of what we just saw? Long term, I don't know that there is. I think we always, in each moment, there's going to be an evaluation of what's the macro environment, what's the underlying root cause of the issue, how, what would the effect of a failure be? The insurance policy is there, like all insurance policies, right? It's to protect a risk, and it's to provide confidence that in an extreme circumstance that there's a level of protection that you can rely upon. And I do believe that FDIC insurance provides that for depositors. It's different, Chris, when you think about it in the context of your company, maybe then, your accounts, or if you have, family members that have other accounts that would be a beneficiary of that deposit coverage. And so some of it's impacted by your, the lens that you're looking at your deposit account balance through. But I do feel that there's value. It absolutely is something that we provide, that we see provides stability and confidence in the industry. And that's one of our greatest assets as a country is, our banking system is well diverse and it's strong. Yeah. So, but it's a really good question, and it's one that, it's interesting and fun at times to debate. Yeah.
Yeah.
I mean, let's not ignore the fact that the politics of all of this are also intense, right? So, something to just really keep in mind, especially given the environment that we're in right now.
Yeah.
Definitely. We even see that in the chat. So, so sharing the results here on who's taking steps to mitigate risk. It looks like exactly 2/3 of the audience here is saying that they are either considering or already making changes to their bank accounts. So that tells you a lot about, how fluid all of this is and how many people are concerned. So I want to make sure that we leave plenty of time to talk about solutions. We've talked a little bit about, I think already, some of the cons of diversifying. Are there any other ones that you want to get to, BC, before we start talking about solutions here?
I mean, I think that, there's just as Chris has already said, I mean, I think that, there's sort of the obvious approach, which is to open bank accounts, move your money around, and that reduces the risk, but it obviously has operational challenges, as many attendees have pointed out. And that's really what it comes down to. How am I going to move monies between accounts? How do I balance my accounts to ensure that I'm staying below the threshold that I'm willing to accept? How do I do my month-end close in a simple way? How do I report my cash balances? That's the flip side of doing it. And what I worry about more than anything else is that once this kind of risk exposure, it feels like it's died down, we'll just sort of fall back into the same place where, naturally concentrating your deposits in one place once again, right? Which is never a good idea. So, go ahead, Ali. Yeah.
Yeah. So one question before we launch into solutions here, one more poll for everybody is, would you be more likely to consider diversifying if you could do it through a single solution? So do you want to launch into talking a little bit about what we have as far as solutions, BC?
Yep, absolutely. So what I think, we have been doing at Santeam is to really kind of, to some extent, address the issues that people will face, whether they choose to do this kind of manual diversification, but also to look at what are the ways in which we can support an automated diversification strategy. So I'm going to, if it's okay, Ali, I think, I'll share a few slides, walk through some slides, and then, just give people a sense for what the universe of possibilities looks like from a solution standpoint.
Yeah, let's give people 5 more seconds to respond to this poll while you pull that up. And yeah, we should be good. Just a couple more seconds. 3, 2, 1. Oh, they're still responding. I don't want to mess it. I don't want to mess anybody up, but we're going to go ahead and close it down. I do want to share the results with you because this actually does show that 85% of people say if there was a single way to do it, that they would be interested in or more likely to consider diversifying. So great insight here.
Yeah, so that's really, I mean, I'll take a few minutes just walking through, what we've been doing. And when SVB happened, right? I mean, Chris, as you know, even we were also banking at SVB for many years and across 4 companies. And then when SVB happened, it became obvious that we needed to do something. And as solution providers and entrepreneurs, we felt like being in the cash management business, it was sort of appropriate for us to think about what the solution might be. We have a very close relationship with FNBO. I reached out to our partners at FNBO and to kind of fashion something or make available something that's already in the marketplace, but I'll walk you through it. So the question is, how do you as a business diversify your deposits, right? So, obviously the obvious approach is, do it yourself, right? Which is what you did, Chris. You take your existing bank accounts, you have a number of other accounts that you would open, your proclivity as to what is large, what is small, what is low risk, what is high risk. Do you know the banker? Do you know the bank CEO? However you assess, what you believe all of these different banks are. And some people would say, I'm going to go to the large money center bank. Some others would say, I'm going to go to my small credit union, whatever, right? So, but basically you end up with a bunch of different bank accounts.
I'd prefer you retitle this slide an appropriate or reasonable approach, but it's maybe too late for that. Go ahead.
Well, let's do this over again and you can do my best.
Okay.
And so, there's nothing wrong with DIY. There's a lot of fun.
Thank you. That's all I needed. Thank you.
But the point is that once you open all your bank accounts, which has some pain associated with it, you then kind of go through the exercise of basically taking your existing bank account and transferring balances. And then, of course, once you do this, you do have, the need sometimes to, move money around because, from an operating standpoint, you probably have your AP and AR in certain banks, and you don't want to be setting up so that, you're making your payables from 16 different banks. And so you end up with like various activities from periodically to sort of move monies around. This is kind of basically the obvious approach that you would take. And this works, but it does have some operational challenges, this kind of approach. Account-to-account transfer between bank accounts is just not easy, right? I mean, you have to do wires, which can be expensive, it can be tedious. The more accounts you have, the more combinations, the more tedium, more costs. Cash reporting is complex, and it just becomes one of these things where you have to aggregate your balances across multiple accounts now, which means like online banking. The more banks you have, the more challenges you have. Month-end close and reconciliation becomes complicated. We also know this, and once again, more accounts, more statements, more room for error. And then the final thing that I think is important, the point I made at the beginning, was that you still need to think about what you started out with, right? Which is, hey, I do need to manually rebalance deposits to ensure that I'm mitigating my risk. You don't want to be in a situation where you're over-concentrated in one bank or the other, because at the end of the day, the reason why you opened all these accounts is simply because, of this stuff. So it works, but there is some tedium. And, in creating a solution, we did address this, for people like Chris, who, have taken on the responsibility of diversifying their accounts by themselves. But what we did do is to go down the path of what many of you have desired, which is a single point of diversification. So I'll take you through this. This is some of you know this as the cash sweep account, but what we've done is kind of take the cash sweep account and package it in a way that provides the additional benefits that you would expect from a solution like this. So the idea is to automatically diversify that account base, mitigate risk, increase security. And the thought was that while we were doing this, why not also address the fraud issue? Because at the end of the day, there is also an exposure that banks, customers have to fraud, and the more you can mitigate that fraud risk, the better it is. And then ultimately not, have the sort of, continue to maintain the relationships that you have with your existing banks. So the way it works is that, we've created, basically a cash sweep account called Centeem Secure. And the way it works is that, you open an account at FNBO. We call this the Centeem Secure account. And then once that is done, you kind of, transfer money as much as you wish, from your existing bank accounts to this singular Centeem Secure account. And what happens behind the scenes is really, really, really important. What happens is that every night, at the end of every processing day, what we do in partnership with FNBO is that we sweep anything that is in excess of $250,000 to a network of about 3,000 banks that are all FDIC insured banks. And no individual bank will ever have a balance which is both your principal and interest of more than 200. I'll say it another way, all banks will have a principal and interest balance less than $250,000. So this sweep happens automatically, and it happens every night. So if you think about this in the aggregate, from your standpoint, you're only worried about one account. No need to open 15 accounts. No need to worry about like transfers across 15 accounts. No need to think about like, what happens with reconciliation, things like that. Move your money to a single account. Behind the scenes, the money is then distributed, swept out across a network of 3,000 banks. And in the aggregate, that gets you from the FDIC limit of $250,000 to $100 million. So right, Chris, we don't need FDIC. No stinking FDIC needed, because what we can do, no, just kidding. We basically are able to, insure up to $100 million because we diversify the deposits across these different banks. This is the basic principle around automated deposit diversification, a single account that then behind the scenes automatically diversifies through this sort of network of FDIC insured banks. So that's kind of one thing, but also, what's important is that your typical deposit account today, this is also coming into higher, David brought this up, is that you can earn higher yield. The Fed funds rate right now is 4.75%. And, what we will do on the Centeem Secure account is pay 2.25%, which is a whole lot better than, 5 basis points. And so that then gets you not only more security, but it also gets you higher yield. But the third part is that people who are looking for higher yield are often faced with the challenge of reduced liquidity. So I can put my money into a CD or something that is less liquid. But the nice thing about the Centeem Secure account is that it's fully liquid. There are no limits on the transactions. Your accounts are, the monies are not locked for any period. If you want to do 5,000 transactions on this account in a given month, you can do that. There is nothing at all that you have to worry about from a liquidity standpoint. So full insurance, high yield, no liquidity issues, right? What's not to like? You get aggregated balances in one place. These are additional features that we've added. I want to walk you through a few screens to give you a feel for it. The convenience of operating accounts in a way that is familiar to you. We have incorporated interbank account-to-account transfers into the Centene Secure product. And the final thing that I want to really highlight is that if, despite using this solution, you are victimized by electronic payment fraud, we guarantee the tune of about $100,000. This set of 6 or 7 things taken together is what we have built, as part of our Centene Secure solution. Do we have time to just do a quick walkthrough of some screens, Ali?
We do. Could you clarify? We do. So go into that. But also there's some questions, I think, about the 100,000 fraud versus, protecting the overall account. Can you clarify that before you jump in?
Sure. There's 2 types of risk we're dealing with. One is the risk of bank failure. And the risk of bank failure is what the FDIC insurance is meant to cover. But by spreading and sweeping the balances across a network of banks, we're raising that limit from $250,000 on a single account to $100 million because of the distribution of the balances across accounts. So that's one risk, the risk of bank failure. The second risk that any business has, anybody has, is the risk of account takeover fraud, the risk of electronic payment fraud. We're constantly being phished. So the question is, how can a solution like this mitigate against that? That's the other thing that we do. We don't have time to go into how we do it, but effectively what happens is that we're buying insurance on your behalf to protect you against that risk. So if it turns out that you want to take advantage of it, that's sort of part and parcel of the solution as well.
Well, can you flip to the slide about the early access program for this in case people want to sign up, and then we might run a little long showing you the product, but just want to show you really quick that if you are interested in joining the early access program to learn more about this, I've got a poll up right now where you can opt in to learn more, sign up, or just let us know if that's not something you're interested in. But we'll take it from here to just ending on taking a peek at the product with UBC.
Yep, sounds good. So can I go ahead and switch to the product overview? Yeah.
Yep, go for it. We'll leave the poll up at the same time.
Yeah, I'm going to, let's see here. So what I'm going to do is to show you a few screens. And so this is the Centene Secure product. We built it, as I said, in partnership with FNBO. And what you're looking at first and foremost is a screen that provides you with an aggregated view of all of your relationships, right? So you have diversified your CRIS, you've diversified, or you have, existing 3 or 4 relationships. You have savings accounts, you have a credit card account, you have a line of credit, you have a loan. Just like Mint, wouldn't it be nice to have all of your balances and transactions in one place? That's one of the things that we have done with Centene Secure. So you can see what are my assets, what are my liabilities from a cash standpoint, all aggregated in one place. Well, how does this take place? Essentially, what happens is that you would, you come to the screen, you would click on manage your accounts. And here are all the accounts that I've added just now. If I wanted to add, let's say I bank at Bank of America, I can add a financial institution. I can search for my bank. I can say, okay, add Bank of America, enter my online banking credentials, right? So, you enter your online banking. We don't store this information. We basically kind of pass it through to Bank of America. We then get access to the accounts that you have, just like with Mint. You choose the account that you want to have aggregated within the Centene Secure interface. You hit save, and guess what? That's now been added, back into this interface. So I go back to the beginning, and now you have all of these different accounts that have been presented. And again, we don't have time, but each of these things you can drill into and see the transactions and so on and so forth. In the meantime, you've also applied for Centene Secure, right? It's a standard account opening process. There's some information that we need from you about your business, your ownership structure, a very standard bank account opening process. Once you do that, then what we will do is to open an account for you. And in this account, you'll have what we call the primary account, which is the operating account part of Centene Secure. And then there's a sweep account, which is basically where the monies that have been swept out to that network of 3,000 banks or so. Once you have opened up these accounts, then what you do is what you would typically want to do is to move your money. Let's say that you parked all of your money at First Republic, there's $8 million there. Within this interface, you would click this account-to-account transfer button, and you would say, I want to move my money from First Republic to Centene Secure. How much do you want to move? You hit the transfer button. That transfer is initiated. Typically, the transfer is done using same-day ACH. So typically, if you've kind of initiated the transfer before 1 o'clock in the afternoon, the transfer will be completed in the same day. But if you hit the window, if you're on the weekend or something, it could cross over into the weekend. But generally speaking, once that's done, you have the account here. And then we will keep $250,000 in the primary account and sweep the remaining out into that sort of network of 3,000 banks. And it's very transparent. You don't have to worry about doing anything. Monies will be swept in and out as your needs are, as your cash needs are to be met. So in other words, if you want to start writing checks directly against this account, you can. If you want to start making deposits directly to this account, you can. If it's in excess, it'll get swept out. If it's in shortfall, it'll get swept in. That's what this will do. But if you also want to transfer monies, let's say out of this, to meet some operating needs that you have, and let's say I've got other accounts here, like I showed you, and I want to move money from my Centene Secure account into, let's say, my Wells Fargo account. Again, you can hit this kind of, account-to-account transfer button, and this is, come on, I can do this. I hope you get the point. What I want to do is to sort of click the button here, and then similarly, you can transfer money out of Centene Secure and back out into any of these accounts that I have. That's the summary of it, really quickly. It's a way for you to, really very easily diversify your deposit base, but also deal with the operating challenges that comes with diversification: account-to-account transfer, aggregated balance reporting, reconciliation, all in one place.
Love it. Thank you so much, BC. We have crossed over the hour. I just want to thank the panel, first of all, for just such a great chat today. We covered lots of topics, and I hope people are excited to see more from Centene Secure. Those of you who have indicated interest, will make sure that you get everything that you need to learn more about that early access program. But to the audience, thank you so much for joining us, spending your afternoon with us. It's been a great session. So thanks, everyone. And again, the recording will go out along with those slides hopefully tomorrow. So thanks, everyone. Thanks, panel.
Thanks,
Thanks, everybody.
You bet. Thanks, everyone.
Have a great afternoon.